Okay, so we're starting in collection process, chapter 5 on 117. And the collection process starts when the IRS makes an assessment. They make an assessment, they send you a bill. That starts the collection process. The bill is usually going to say, we want our money in 10 days. And then hopefully you'll answer them or pay them. Nobody's going to pay them. Anyway, so the IRS has 10 years to get the money from you. If they don't get it in 10 years, unless you've made some other kind of agreements, that's it. Okay? However, the IRS and the taxpayer may agree to an extension. When would that happen? You do something like an installment agreement, or while you're in the middle of bankruptcy, other things that can extend. Extension is agreed to in writing before a levy is released, all kinds of things like that. Okay, basically you just got to read this as much as I can. Statute of limitations on the collection can be suspended for various acts. The IRS must notify the taxpayer that he may refuse to extend the statute of limitations. You don't have to agree to it. But filing a petition of bankruptcy under Title 11 of the U.S. Code automatically stays the assessment and collection of taxes.
So that automatically stops the collection, Chapter 11.
The stay remains in effect until the bankruptcy court discharges the liability. What does that mean? Well, you're in bankruptcy, they can't go get you. They can't go collect the money. But that doesn't mean that it goes away. That means they can't collect it. There's a form called an 872A, special consent to extend the time to excess taxes. Indefinitely extend the period within which a tax may. So you can actually have this form that you agree, in return the IRS will give you extra, they won't come after you. You agree to extend the statute of limitations. So a taxpayer is unable to pay the full amount, he is expected to pay as much as possible and contact the IRS for assistance. Usually they will attempt to determine the best method to get you to pay. They're going to usually go with Form 433, A, B, or F. There's another one called 433D that's just to make so that you will get a direct deposit so that they get paid. Let's say it's an installment agreement and you have to fill that out, send it in so that they get your bank information.
Isn't that on the installment agreement?
Huh?
Like asking for your routing number and all that? Oh.
But sometimes you do it over the phone, and so they make you fill out that form.
Oh, okay.
But the other ones are, if like 433A and F and B, one of them is for if you're self-employed, and the others are basically they want to know your name, address, everything. Then where do you bank? What assets do you own? Do you own a home? Do you own a car? Do you own a bunch of Bitcoin? By the way, I just got an email from the IRS saying they're going to put on, this is not part of the class, they're going to put on the new tax return on Schedule 1, there's going to be a line, yes or no. Did you have any, did you buy, sell, trade, do anything with Bitcoin? They don't say the word Bitcoin, they say, I think, virtual currency.
Oh, wow. I'm very specific.
Okay. One of mine too, and he's lying. So I may have a problem with him next year. He just told me I didn't do anything with it. I believe he's not telling me the truth. I'm now going to have to ask him point blank, and I'm going to write down, Joe said that he did not do any Bitcoin. I asked, just to cover. Okay, so installment agreements. Remember the interest and penalty, this is one they always ask, will keep going as long as you have an installment agreement. Also, when you have an installment agreement, they will charge you a fee. And I'm not sure if they're going to ask you all the numbers of the fees, but they have before. Okay, so installment agreement payments must be made on time, this is for an installment agreement, and must provide a financial update if requested. What does that mean? I tell them I'm just a poor, starving waiter in a hotel, and then my uncle dies and leaves me $1 million. I've got to tell the IRS, oops, I got $1 million, and IRS is going to then send me a bill.
Paid in full, gotta be.
Yes, and if you don't, you'd be breaking the installment agreement, and then they could go get it any way they wanted. Okay, so they can, if you're financial, you lose your job as a waiter, and then all of a sudden you hit the lottery, your uncle dies, or you get just a better job. They can change all that, okay? You know, they install, basically all this stuff, you guys just need to read it and just highlight it like we're doing. Installment agreement, there's setup fees, they got user fees, and here's you a list of them. Under, this is number 4. Okay, there is a $89 fee to modify the installment agreement. I get a lot of my clients get hit with this stuff regularly. And today, several of my clients, they go, do you want me to set an installment agreement? And they go, oh, I already have one. I go, one of the deals of an installment agreement is you're not supposed to owe them any more money. You're supposed to be paying down the installment agreement, not letting it keep building up higher and higher. Reduced installment agreement fees, this may be one, is a $43 fee, and you're supposed to use this application for a reduced fee called a 13844. I don't think they're gonna ask you that number, but that's the kind of stuff. Request to modify or terminate an installment agreement, there's an $89 fee to modify the agreement. When does that happen? I owe them from 2017, I file my 2018, I can't pay them, and you'd want to modify it.
Oh, so you can just basically add on to the old, or if there's a new balance to, like, for the new return.
So you owe them $3,000. You file your 2018 today, then yeah, you're gonna get another letter in about a month.
Right.
And so you probably wanna call and say, I'd like to modify it, and they're gonna charge you a fee for doing that.
Okay.
To include the new year.
And they're not gonna let you keep doing this after a while. About the 3rd year, this is a personal opinion, they're going to do something like going, we'd like for you to drop your exemptions to 0, if that'll work, or they'll say,
Do they, like, assess more, like, on your, what you own, like, if they do that? Or what do they do with that?
well, if you work for somebody, they just say, drop your exemption to 0, so you start having enough taken out. If the people that really are the ones getting it, self-employed people, people that have a S-corp, people that have a bunch of interest and dividends, that kind of stuff, where they don't have any withholding, or idiots that have a bunch of pension income and have 3% taken out instead of.
Or no taxes at all.
Yeah.
A lot of them don't take taxes at all.
Yeah, they don't want to pay taxes. All right. Even while you're in an installment agreement, they can still file a federal tax lien. That's a question they ask a lot. For amounts between $25,000 and $50,000, installment agreements, they do not require the taxpayer to complete a 45F collection information. However, direct debit information must be provided. Just read this. I'm just going to get confused. Guaranteed installment agreement if it's under $10,000. That's another one. Guaranteed installment. Hi, ladies.
Oh, really?
Just pull up. Yeah. Because nobody was here, we just started sitting here.
Oh, how big is that out there?
We're on page 119. We're not that far. We just got started.
Okay.
A few minutes ago.
I know my pages are different.
And this
from yours.
stuff that we're talking about is installment agreements. So this whole thing is about collection.
You need five? Oh,
Five.
installment agreement.
First collection, when does this collection begin? When the money is assessed, when they send you the first bill. If they don't ever assess the tax, they haven't started collecting yet. Statute of limitation is how long? 10 years. This is important. You get somebody that comes into your office that filed a tax return in 2005, 6, or 7, their 10 years might be up. If they never file, when's the statute of limitations? There is no statute of limitations until you
Until
file.
they file them.
Okay? Guaranteed installment agreements. If it's under 10,000, they've got rules for guaranteed installment agreements. During the past 5 years, to get that guarantee, you must have not failed to file your tax return, pay your income tax, or entered into an installment agreement. Now, even if you've done any of that, you can still get an installment that is not guaranteed. What is it? Other than that, you gotta be financially unable to pay, you gotta pay them within 3 years, and you gotta comply with tax laws while the agreement's in effect. What does that mean? When you get an installment agreement, you're supposed to pay them in the next years. So if in the year 2017 you get an installment agreement, then you're not supposed to be owing them in 2018. And if you do, when you file your taxes, you're supposed to pay. You're not supposed to get another installment agreement and keep it going up instead of going down.
But it is possible, right?
It is. In fact, I just did it today. The guy already had an installment agreement. He owes more money. We're gonna get it. Yes, he's gonna revise his installment agreement. It's gonna cost him another $89.
Oh, they charge for every time they add another year?
Yes.
Oh, I didn't know that. I don't-
They got little penalties in there.
Ah.
Okay, here's another thing. Currently non-collectible. You can get currently non-collectible status. You have a little old lady that's living on Social Security. She gets $10,000 a year. She's living in Hawaii. She doesn't have anybody to live with. She's paying her own rent. Well, she's probably currently non-collectible. She owes you $50,000 because she and her husband had a business and they didn't pay their taxes. Husband dies and now she's a little old lady without any money or income. You're probably not gonna get that from her. I've had a couple of those, but they don't want to do that. And if things change, the little old lady gets an inheritance from her brother, then all of a sudden they'll go back after the money. But sometimes the little old lady's never gonna have any money, so they just leave it as uncollectible. Currently non-collectible, you need to know the difference. Extension of time to pay. Undue hardship, more than an inconvenience. What does that mean? I'm a mom with 3 kids living on $12,000 in Hawaii. I'd say that was a hardship. Okay, basically read all this. Collection appeals program, just read this. In addition to contesting IRS assessment, taxpayer may appeal to collection activities. Okay, so they can't levy, let's see, you're living on Social Security on $12,000, they can't levy to take a third of your Social Security. That would be pretty much inhuman. Especially if it puts you out on the street. What do? They're gonna say it in here, but you go to the taxpayer advocate's office and go, help, they're being mean to me, or they're being mean to my client. What can we do? And in that case, that's really easy. They would step right up and go tell the IRS to back off, and they probably would. On the other hand, if you say that kind of stuff and it's not true, then that's not a good thing. Okay, what is that? It's in here somewhere, but right off the top, to go to the taxpayer advocate, you file Form 911. You know, like calling 911 for an emergency? That's the same 911 as the form to get the taxpayer advocate. I personally think it's easier to call them. If you want a collection appeals, there's a 9423 collection appeals request. Okay? And you can just read all this. There's nothing I can tell you much. But if they don't give you an installment agreement or whatever, you can appeal it. Does it happen very often? Not really. The only time they don't give you an installment agreement is when you got a tax return that they're still working on. I had it with a guy that identity theft, because he'd gone to a tax preparer. The taxpayer had, the guy's pretty much an idiot. He'd gone to like a Starbucks, and the guy goes, "Here, give me your documents and $400, and I'll get back to you." He kept calling the guy, and the guy does nothing. Well, then he gets a $8,000 refund in the mail. Never got a copy of his tax return, never signed anything. So, and then a couple years later, he gets letters from the IRS going, "I'd like for you to, provide documentations on your business and all this." He didn't have a business. And then he came in, we went and got copies of his tax return and go, "Oh, you had a business and you lost $50,000. And that really, and he had, like I say, $100,000 income. That made him get a great refund." But it was all fraud. So anyway, we amended his tax return, got it all straight, but in the process, there's a special form that you can fill out to snitch off a tax preparer. And we filled it all out, gave him the guy's name and phone number, and did all this. And while they were doing that, they wouldn't give him an installment agreement. So he was wanting to pay them, and they wouldn't let him, because he was in the process of doing that. He was asking for an abatement of the penalties associated with this guy. He didn't sign anything. The guy that did this didn't sign anything either. He put it down as self-prepared. So, first of all, I have a little sympathy for a guy that he just says, "I didn't know what he was doing." His friend had told him about it. His friend's also being audited. His friend had done it for 2 or 3 years, and now he's got to give all the money back too. But if you just go hand somebody $400 in cash, you don't get a receipt, hello, he probably deserves what he got. Okay. Just read about administrative signing. There's not much I can tell you. Refund offset, you already know what that is, right? If they have a big refund and you owe the IRS can take your this year's refund for last year. Or if you owe child support, they can take your refund for child support. Or if you owe the state, your state might be able to take it, only if it's a state you're living in, I believe. Those are, but everybody has got that, right? That's offering compromise. Let's go into this. Okay. Refund, one other thing, refund offset. The IRS takes for the IRS. Everybody else, it's the Treasury Department's Bureau of Financial Services. So if you owe child support it's the Bureau of Financial Services that collects it. Everybody's gone. Have you ever called those guys? We used to do it a lot more than we do now. You know, and then you go, oh, child support, student loan. That's who takes the money for those kind of guys. Okay, offer and compromise. An offer and compromise must reflect the taxpayer's maximum ability to pay. So if you get somebody coming into your office and go, oh, I want to offer them $1,000 on my $40,000 I owe, that's ridiculous. You know, that's not going to work. It's got to be realistic. It has to reflect what they can pay. So if I'm making a bunch of money, the IRS has 10 years to collect, right? So they just keep collecting for 10 years. They could go garnish your wages, or what else could they do? If you just had wages, that's it. If you had something they could take, you have property, you have money in your 401k, they can take that. They can take your whole 401k, your IRA. Okay? So, but on the other hand, if you go, look, I owe you 40 grand, I had a business, I lost the whole thing. Okay, so now I'm broke, I'm out of business, I'm working at McDonald's, I can't really afford to pay you. So, and you go, but my mother will give me the money to get straight with you guys. Can we make a deal? Okay, that is one that can happen. But if you go, oh yeah, I owe you 40 grand, I'll take it out of my savings to pay you guys. Well, no, they just go, give us the money out of your savings. They don't have to do an offer and compromise. If you've got the money, they get to have it. It's got to be something where they can't get the money. If you have the money in your 401k, they can take it out of your 401k. They might do that, but I don't think so. Okay, so what are the rules? The Commissioner of the IRS has authority to compromise all taxes, interest, and penalty other than those related to the alcohol, tobacco, and firearms. You got to know that. I don't know why that's important, but I've seen it for years. Okay, and what does that mean they can get? They can get you out of the interest and penalty. Normally, you don't get out of interest very easily. Okay, the compromise may be made on 1, 2, or all of these 3 grounds. Doubt is to liability, doubt is to collectability, and promotion of effective tax administration. That's kind of a gray area. Doubt is to liability. You've got good reason why you don't really owe this money. They've got you down for $500,000 of stock sales. And you go, I didn't sell those. They were supposed to be, something happened and I gave them to this guy to sell, and he stole all my money. He cashed in my stocks and stole the money. That, you may not really owe the IRS all that money on that, in that situation. The other is the mostly, that is to collectability. You don't really owe it. The other one would be you don't have the ability to pay. And that's the biggest one. I owe you guys $50,000, but I'm a poor little old widow. I'm living on Social Security. I'm never going to have any money. And you go, my son will give, instead of me giving you the 50 grand, my son will give us he'll give me 10 grand to pay this off and get it cleared. Yes?
Like, see this, I have a client who wants to do an YC, and he doesn't have receipts. So
He wants to do what?
He wants to do an OIC, offer and compromise.
Okay.
And
He doesn't have any receipts.
yeah, he doesn't have any receipts for a lot of the years. And so would that fit in that bill where, what is that, down to the liability?
How, okay, they've already assessed the money?
No, not, well, yes, but he
And-
wants to try and do an offer and compromise.
And saying, I don't really owe that money because,
I didn't report any real, like, material expenses or, yeah.
but he didn't have any receipts. Have you ever heard of the Cohen Rule? You guys heard of the Cohen Rule?
No.
Famous rule. You should know, everybody should know this. This is, okay.
Cohen?
There was a Cohen, in 1930s, there was an actor named Cohen. He was a famous song and dance. He used to use blackface and I can't even, hello, mammy. Anyway, anyway, he was a famous actor.
Keep going.
I can't sing. He traveled around the world, did a bunch of stuff. He lost all of his receipts and his cars, it got stolen, whatever. The IRS says, you don't have any receipts, we're not gonna let you write anything off. He took it to the Supreme Court and actually won. The Supreme Court, that's unrealistic. The guy travels around, it's obvious that he had these expenses, so you have to give him credit for some of it. Okay, so now in this day and time, I have a business. I made $300,000 selling things at the swap meet. I had to have bought things to sell at the swap meet. So even if I don't have receipts, because nobody has receipts at the swap meet, he could probably use the Cohen Rule, and they would give him at least credit for a reasonable amount. The problem is what the IRS says is reasonable and what you say is reasonable are two different things. But that is that he could use that Cohen Rule. And you can go Google it, Cohen Rule, C-O-H-A-N,
Oh.
C-O-H-O-N, Cohen Rule. I don't know if you can, I think you can even, I've got it, and you can even get it in the IRS, irs.gov, I think even has it.
Oh. Okay, good to know, thank you.
But there's no guarantees that they're gonna say, now, what did they do? Just take his gross amount, took no expenses, and that's it?
Yeah, that's what I did. I told him, if there's no receipts, then no. I took.
Reconstruct his expenses. How, and do an amendment. Has it been 3, well, he hadn't paid them, has he?
No, actually, this is the debt is over 100,000 now, and it's back from 2011. So,
Okay.
there's some years he worked as a W-2, but there's a lot of years like
What was he doing?
Construction, divorce.
The IRS loves construction guys.
But the thing is with him, like he's to me, I think he's over-reporting because there's no materials, and there's gotta be materials or even like
And tools.
Yeah, tools or
And
just
cell phone, and a lot of times your
auto,
vehicle.
yeah, your vehicle.
But you could reconstruct the expenses.
Yeah, and I had asked him, do you even have a calendar? Oh no. Do you have receipts, like the job invoice? No. Oh my God.
Well, he just doesn't want to do anything.
Yeah.
Well then,
For me, it's like, well, I'm not gonna do it for you, so you gotta pay. He was fine with it. He just wanted to file and just move on. But
and now he
the
wants to
debt-
offer him compromise.
Yeah, because the debt is just overwhelming him. And it, yeah, it's.
And what is the IRS doing? Are they levying his wages?
No, no.
Then how are they over?
Well, he has an installment agreement, but I told him, I just.
Well, lower your installment agreement if you can't pay it. Say, I can't afford to pay this much. I need to lower it. But part of it is that he's an idiot, and it's not the IRS's fault, it's not your fault. As, what was that show with Tom Hanks? You can't fix stupid, what was that? Oh, it started with a G.
I was thinking Forrest Gump.
Forrest Gump, that's it.
Oh.
Okay, anyway, so, there are two types of offer and compromise payment terms. Lump sum payment must be paid within 5-year installment. This you have to know. Periodic payments must be paid blah, blah, over 24 months. There's make sure you know that there's a $186 application fee. And this is the key. This is where that stops, it separates the everybody, men from the boys, so to speak. It's a non-refundable 20% of the offer amount for a lump sum. You have to give them 20% down of what you're gonna offer them. I'm gonna offer you 10 grand, so I gotta give you $2,000 down, and I don't get it back if I make an idiot offer. And so that's the IRS, because there used to be a lot of, just dummy offers. Well, now you make some kind of offer that's not realistic, then the IRS goes, great, we'll just keep your money. Okay. An initial proposed payment for a periodic offer. Okay, so the remaining proposed periodic payments must continue until the offer, while it's being evaluated. So you keep paying them whatever that period, well, they keep dragging their feet, and 6 months later, then they decide, we're gonna keep it. If the taxpayer is based on the offer and compromise on doubt of liability, I don't owe you the money, then you don't have to pay them that 20%. You have to fill out the form 656L, okay, instead of the 433A or 433B, whichever fits. The 433A and B, have you ever done this before? It's where they put down, you list all your assets, and at the bottom it says, my monthly income is this, my monthly expenses are this, and at the end, the difference between the two, they go, we'll take that every month. You familiar with that?
This is the 433.
433, A, B, there's also an F. F probably is for former, I don't know. Okay. Okay, part of this offer and compromise, if they agree to it and you pay them, you have to remain in compliance for the next 5 years. What happens if you don't? Then they just say, okay, you jughead, we're gonna make you now, the offer and compromise over, you now owe us the money that you should have paid us. I'm ad-libbing a little here. Okay, taxpayer assistant order, that's the taxpayer advocate's office. I never use that name. They fool me. Taxpayer assistant order, what's that? It's the taxpayer advocate. Is everybody here familiar with taxpayer advocate? It's the greatest thing since sliced bread. You're having problems with IRS, and the person you're dealing with is being a jerk. I had a lady this was years ago. We had a father with 2 kids, lived with his sister. He didn't make much money, so he let his sister claim the 2 kids for earned income credit. Completely legal. The lady wouldn't accept it. Goes, no, he lives in the house, so she can't claim him. I go, yes, you can. Then I said, on page 27 of Pub 17, second column, and after I said that, she goes, if you say anything about Pub 17 to me again, I'm hanging up and I'm not going to ever talk to you again. So I go, whoa, okay, and she goes, no, you can't do that, you're wrong. So I went to the taxpayer's advocate's office, actually copied those pages, sent them to the taxpayer advocate, had the other lady had asked me for information before I went So she asked me for a birth certificate, social security card. I got every bit of it. I sent them to her. 2 weeks later I called, she said, oh, I never got them. I sent them again. 2 weeks later, I never got them. Third, so then I went to the taxpayers advocate and explained what's going on, showed her all in writing. And so the taxpayer advocate called her up with me on the phone and told that lady that I'm going to wait on the line as we send this stuff to you, and I want you to confirm that you got it before you get off the line. And so she did, and a week or so later when we tried to get back, that lady had been taken off the case. But I had never been treated that bad by somebody from the IRS like that. I think she was from Atlanta. I've had more trouble with Atlanta than anywhere. I don't know what that means, but I have. Okay, so taxpayer assistance, what do? The taxpayer assistant, taxpayer advocate's office is responsible for issuing taxpayer assistance orders. And what does that mean? You have a little old lady that's barely getting by, and the IRS is beating up on them and go, we're going to take your house, we're going to levy your house and take the whole thing. Well, you call the taxpayer advocates, and the taxpayer advocates goes, cut that out. This little old lady needs to have a house to live in. You can't take it. I don't care if she owes you $100 grand. She's living on 12,000 Social Security. Oh, and there it is. There's where it says Form 911. So, but I'm telling you, don't do that. Go to the phone. Just call them up. You can go irs.gov, taxpayer advocate phone number. You can Google just taxpayer advocate, and they'll give you the 800 number. If you can't find it the other way, I have their local office, but their local office right now is short-handed, and so you're better almost to go to the national and get it that way. Okay, interest is generally figured from the due date of the return, okay, to either the date of the payment is made or the billing date if it's within 21 days. That's a question, that's one they're going to get. Injured spouse, is everybody familiar with injured spouse? The 8379. Okay, there's not anything I can really tell you that you shouldn't already know. Separation of liability relief, an innocent spouse may also qualify for relief under separation of liability. You got two people, you have a husband and a wife. The wife goes to work she works for the state. The husband is self-employed. He happens to be a drug dealer on the side. She doesn't know anything about it. Yeah, right. But then he gets caught, gets in trouble, owes $100 grand. She goes, I didn't know anything about it. She applies for separation of liability. She only pays her taxes. That'll work unless he gave her a brand new Mercedes saying he was a construction worker. Or they have a nice $1 million house. Then it's hard for her to say, I didn't know this. On the other hand, I had this one. This lady was from Japan. She did not work. She basically played tennis all day. And her husband was worked for the airlines, and he was a tennis player. That's how they met. But anyway, so she didn't work. He did. He didn't pay his taxes. And when they got divorced, he owed for several years of taxes. But because they filed married filing jointly, she also owed. Okay? And he was abusive. So we went to the IRS and recorded the abusive part and said that she had no income, no money, none of his taxes that were owed. He just didn't have any taxes taken out. He was just underpayment of his taxes. Even when he had a wife that didn't earn any money. The reason she had to do this is she had a fairly wealthy dad. She was in her 50s or 60s. She was not a spring chicken, but she was getting ready to get some money. And she didn't want the IRS they transfer $100,000 into her bank account here. She didn't want the IRS taking her money because of what her husband did. So that is separation of liability relief. Collection statute expiration date. The last day they can collect unpaid tax from taxpayer consists of the year, month, and date. They already have 10 years. So that's okay. A lien. What is a lien? A person neglects or refuses to pay a deficiency after demand. The IRS can put a lien on your property, on whatever you've got, or on everything you've got in general. That means if you sell something, you got to pay the IRS before you get it. So usually, think of property. I own a house, and they put a lien against my house. I owe them $100,000. Then before I can sell that house, they get that $100,000. Okay. When the IRS files a notice of federal tax lien, all creditors of the taxpayers are notified of the lien. The result of the attachment of the lien to all the taxpayers' property, including property that is required after the notice is filed. So, they file the notice, and then I get inherit a piece of property from my mother or father. Boom. They get to put a lien on that property even though he got it afterwards. Okay? That's pretty. These are, you might get these questions, you might not. Before the IRS files a notice of lien, 3 requirements. The IRS must assess the liability. They got to tell you owe it. The IRS must send notice of tax due and demand payment. Not a problem. They will do that. The taxpayer must neglect or refuse to pay within 10 days. No problem. Is there somebody there? No. At 8 o'clock, I have a client that's going to come by and finish her tax return.
Well, I talked about last minute.
Well, she came by before twice and didn't have the paperwork.
Oh.
Okay. The taxpayer must notify the IRS must notify the taxpayer in writing with 5 business days after filing a lien. Okay? That's a question they may ask. Recording a notice provides constructive notice to potential purchasers and creditors that the government has a claim against the property. What does that mean? You pay this guy in cash for his property, and he takes the money and runs, well, then you, the creditor, are out of luck. You shouldn't have done that anyway. Okay. Release, just go ahead and read about you want to release a lien. You got to know the 30-day rule. The IRS will issue a release of a lien within 30 days. That's a question sometime. And the tax due also includes all the fees that everybody might charge you. The city, the county, the state might have fees for putting a lien on there, like they do. Failure by the IRS to release a lien allows the taxpayer to bring a civil suit. That doesn't happen very often. Appeal, the taxpayer may appeal the filing of a notice of lien. There's the form 12-153. I don't know if they would ask you that and done anything. Just read that about appeal. Levy. What's the difference in levy and a lien? A lien is they just put a lien on there, and if you sell the property, they get their money. A levy, they're going to take your property. They can levy your wages. They can levy your property. They can levy a lot of things. There are a few things they can't, and we'll get to that in a minute. Notice and demand for a levy. Before a levy action can begin, the IRS must make a determination of tax liability and assess it. So you see this is a common thing. First, the collection process is to assess the liability. And all throughout this, they have to assess it. Okay, notice and demand within 60 days after making the assessment. The IRS is required to provide a notice. Okay. Must be left at the person's home or usual place of business or sent by mail. I can't basically just read this thing. That's all I'm going to do is read it to you. Final notice, the taxpayer does not pay the tax within 10 days after notice of demand. A notice of intent to levy must be provided at least 30 days in advance of the levy. That's another one. A levy, before you can levy, you have to provide 30 days in advance of notice. Okay? Must given in person, left at the taxpayer's home or usual place of business, or sent by certified mail. Jeopardy levy, what does that mean? They're in danger of losing it. If I have a Rolls Royce car and I'm a wild and crazy drug dealer, and if they let me know that they're going to levy within 30 days, I'm taking that car and I'm beating feet. I'm on my way to Mexico. Not from Hawaii, but if I was in California, that's what they would do. I think. I don't really know. Okay, but do you understand? The jeopardy levy is based on the collection of tax. In most cases, the following are insufficient basis of a jeopardy levy: a bankruptcy, and just all this stuff, just read it. Exercise of levy. Certain property is exempt. This is important for you to know. Wearing apparel necessary for the taxpayer or family members. That does not include all wearing apparel. If I happen to have a couple of mink coats that I wear, that doesn't count. But for my regular wearing apparel to go to work and live a life, they can't take it. School books, undelivered mail, unemployment benefit, workman's comp, certain annuity and pension benefits, minimum exemption for wages. So they can't take all my wages, they can only take a portion. But even if they take half, that's going to put a dent in your lifestyle. Principal residence, unless the levy is approved in writing by a judge. So mostly they don't take your house. Tangible, personal, and non-real real property used in a trade or business. If I have an ice cream store, I have a little building somewhere, and my business is selling ice cream, they can't take my location because throws me out of business, and then I can't pay them. They can also levy a state tax refund. After seizing the property, they got to sell it. This you need to know, they have to sell it between 10 and 40 days after giving public notice is given. Just read, same thing, just read it. Any real property used as a residence. Any real property used as a residence by the taxpayer cannot be seized to satisfy a levy of less than $5,000. $5,000? That's so small. They're going to take your house for $5,000? Okay. Levy on wages. Okay. A levy on wages begins on the day the levy is enacted until the levy is released. They've paid it. The levy becomes unenforceable. So how much the exemption they can't take is your standard deduction divided by 52. So if you're a single guy, that's $12,000 divided by, just even say 50. 1,200 divided by 5. That's not much money they're leaving you to live on. You can't live on that in Hawaii. 1,200 divided by 5. That's $240, is that right? Yeah, they're doing 52. So, can anybody live on $230 and even pay rent?
Not here, or not.
Okay,
Meaning they'll leave you with that much, $200?
Yes.
Oh,
They'll take the,
they'll take the difference.
yes,
Oh, yeah, like, no.
that's not gonna work so much in Hawaii. There's probably special rules for Hawaii going, you'd be a homeless person. Okay, but anyway, I just wanted to show you that's kind of ridiculous. Okay, discharging taxes through bankruptcy. Generally, you can't just do that. Taxes must be at least 3 years old. Will not charge taxes through bankruptcy unless certain conditions are met. Applicable to tax returns and tax assessments independently. If any one of the following qualifications are not met or are off by a day or two, the taxes will stay. So that means they're pretty strict. Solely for income taxes, must be 3 years. Tax return files within 2 years before bankruptcy filing. They were assessed at least 240 days ago. No fraudulent tax activities. Taxpayers must provide to the court that the last 4 years of the return have been filed and must have a copy of the most recent return. How many of my clients don't have copies of their returns? And they try to get them off TurboTax and go, I don't remember my password. Ugh. Sorry.
they just e-file it and they don't print it out.
Yeah. Okay, trust fund recoverability. Does everybody know what we're talking about? Trust fund recovery. If you have payroll taxes and you don't pay the payroll taxes, that's the trust fund recovery. Because I have a guy, he makes $12,000 a year, $10,000, we'll make it 10, and I take out his Social Security, his Medicare, his federal income tax, and even his state, but the state doesn't count for this. So then he's supposed to match the Social Security and Medicare the company is. So the money that took out of his taxes, that's a trust fund. You're holding that money for the government. That's not yours. And you're not supposed to spend it. The penalty is 100%. The penalty doesn't apply to the part of Social Security and Medicare that the company paid, just the part that was taken out of the guy's wages. This is the worst penalty pretty much there is. So the only catch is that on the questions, they'll include the company portion that the company was supposed to pay as a trust fund penalty. That's the trick question. So who is responsible? This is really, so let's say you're working for a company and you were in charge of payroll. You're the one paying the payroll, paying in the 941, and your boss goes, we're short of money this week. Just don't pay it. Not a good idea to keep that job. I would suggest you quit.
What about if your client doesn't pay their payroll taxes, even though you keep everything something, how does this, what the?
As long as you're not responsible. Now, here we go. An employee is not responsible if his or her function was solely to pay the bills as directed by a supervisor rather than determine which creditors would not be paid. If you're the guy in charge and you've got to say, oh man, we're short this week. Well, this time I'm going to pay the people we owe so we can buy more supplies. Let's just say you're buying supplies to make bicycles. And you had to pay you had to pay Schwinn or whoever makes your bicycles, or they're not going to send you any more parts. But if you pay them, you can't pay your payroll taxes. If you choose to do that, even though you're an employee, you would be responsible. An employee is responsible. The owner of the company is responsible. The, who else? The board of directors. All the people that, anybody that really, officer or an employee of a corporation, member or employee of a partnership, corporate director or shareholder, member of the board of trustees.
What about payroll processors? Like Ceridian or?
No.
No, they wouldn't be responsible?
They just won't give you payroll.
They won't keep doing payroll, I wouldn't
Yeah,
think.
They
Yeah.
won't keep you as a client.
They have to, you have to,
They would have to pay, right?
yeah,
Yeah.
they, either that or they gotta drop you.
Yeah.
They couldn't willingly let you do that and keep not paying it. It goes out, they take it out of your bank account, they don't pay it for you.
Mm-hmm. Yeah, 'cause we process a couple payrolls, and there's clients that's like, oh, wait till the last minute. And I just had one the other day, they told me not to pay the 941 because it didn't have funds, and I told them, well, that's one of the things you have to pay because that's not your money.
Yes.
And yeah, I already explained that to them, but.
It's either you gotta go or I can't be your accountant. Not if you're the person doing all that. Don't do that.
Yeah, 'cause I was looking it up and I thought, oh my gosh, am I gonna be responsible for this?
And what does this say? Yes, you are.
No, but I'm not an officer of their company.
No, you're their accountant.
Yeah.
So in that sense, would you like file the forms and just let them get notices so that?
No,
you're
I would
aware?
quit.
Okay.
Yeah.
I would, no, if I'm the
Supposed to have that
payroll,
money.
if I'm the payroll person for the company,
But it's for the client, not your company.
Like your client, like
don't keep working for that, you gotta,
Drop that client.
that's
Yeah.
our client.
But what if our company wants to keep them?
you tell that person to somebody put it in writing that they're responsible, I'm not gonna be responsible for that. Then you start writing emails to this saying, I am not responsible, you personally are responsible, and show them this, this page somehow, and they'll either fire you because they're not gonna want you to email them this
Yes.
stuff. Because that gives you proof that you're responsible for this. Do you wanna be responsible? I cannot. And, they're not gonna, they'll either fire you and get somebody that'll do what they want,
Yeah.
kind of thing.
But what if they just don't have the money in the bank? Because if you do their booking, they kick them too.
Well, that's the owner's responsibility.
Well, then
to
they
pay.
gotta quit paying their other bills.
Or get a loan or something.
They gotta quit paying their other bills and pay the 9-1. They can't choose to pay the other bills and not pay the 941.
And the state taxes.
No,
I mean, they have to pay either.
the state withholding, you mean, not
Yes,
state tax?
state withholding.
They can not pay the GE tax,
Yeah. the
not pay the income
That
tax.
too.
And
Just one.
I cannot say for sure, but I'm pretty sure the state's got the same rule. Okay. This chapter is sort of important because we're gonna have to always help these people pay their bills from time to time. We're gonna represent them. As enrolled agents, this is one of the things we do. So this is kind of important. Learning the rules to offer and compromise, learning the rules for installment agreement. Everybody here has done installment agreements, right? I mean,
Oh,
that's,
well, no, not yet.
okay. That's just something you need to be doing. You can help people out by doing this. And, but you gotta tell them what's going on. Okay, now, does anybody need to go to the restroom? The next chapter is the most worthless chapter of all 3 parts. I don't know if anybody else has read it. I have. And I've read it each year, and I've thought the same. So this is tax authority. So this does not really apply to most tax preparers, 95%. Only to the big guys that are taking courses, taking things to tax court, or have big problems. Generally, you don't go to statute and go through this, but we're going to do this anyway. Taxing authority. The tax law is comprised of three basic sources of authority: statutory law, administrative, and pronouncements. Administrative, pronouncements, and judicial decisions. So what's the first one? Statutory law. What is that? The Internal Revenue Service Code. That is Title 26. Everything in there is Title 26, pretty much. Okay? And what is that? That means Congress passes a bill, and that is the Internal Revenue Service Code. Is the primary source of federal tax law. And, they're saying the Internal Revenue Service Code of 1986 is the primary source of federal tax code. But even though they just changed the tax law a lot, that's what they still say. And so that's, for your test, that's what you want to say. And they also go, the Job Act's changed a lot of stuff. Okay, so committee reports. The committee reports are useful tools in determining congressional intent behind certain tax laws. Okay, treaties. A U.S. tax treaty is equivalent to statutory law. Remember that. Tax treaties. So, do we use tax treaties much? No, just a few for 1040 NRs, but there's a lot of tax treaties out there. Okay? Regulation, rules, and procedures. Regulations. General authority to the Secretary Treasurer to prescribe all rules and regulations for the enforcement of the code. All regulations are written by the Office of Chief Counsel, and they're approved by the Secretary of Treasury. You got to know that. I hate just reading it to you. Treasury regulations are authorized by law. Nevertheless, courts are not bound to follow such administrative interpretations. Okay? The courts don't have to follow Treasury regulations. Who does? The IRS. Oh, that's the next sentence. The IRS is generally bound by regulations. The courts are not. That's another one. That's one of the key things. The Supreme Court has stated Treasury regulations must be sustained unless unreasonable and plainly inconsistent with revenue statutes. Okay? A regulation can be characterized as one of three types: legislative, interpretive, or procedural. What's legislative? Yeah. So, where do the legislate comes from? Congress. When the Treasury promulgates a legislative regulation, the regulation has the force and effect of law. A legislative regulation is as binding as a statute, and within those three little ones and one. Interpretive. An interpretive regulation explains the meaning of a statute. It's not as powerful, though. Procedural. So procedural is under the code of the Commissioner of the IRS, not under the Secretary of Treasury. They are binding on the IRS, and They prescribe regulations describing obligations to file forms, and information appear to be given the force and effect of law. All of this drives me crazy. It's so much gobbledygook, but you're gonna have to know it generally because you're gonna get questions over this. I don't think there will be as many in this chapter as the others, but there will be enough. Because if there's only 7 chapters, so you're gonna get 15 to 20 questions a chapter. They're not that big of chapters. Okay? So regulations can be proposed, temporary, or final. Guess which one is the most important? Final. Okay, proposed. They propose the regulations, then they can have, if somebody asks, then they can have a meeting about it. There are issued to elicit comment from the public. Public hearings are held if written requests are made. I don't know if nobody made a request, would they have anything? And proposed regulations might be useful as somewhat of an authority for taking a position. They're not, notice them. They're published by the Federal Register. That might be important. Now, proposed, they're just proposed. Temporary are the temporary regulations. And they're temporary. Okay? When you issue a final regulation, the temporary regulation goes away. Basically, still just read all this stuff. And you're gonna have to read it. There's no other way to do it than just reading this chapter. And maybe even going over it twice. Authority of the regulations. The IRS is bound by the regulations. The courts are not. Revenue rulings is an official interpretation of the Internal Revenue Law as applied to a given set of facts and is issued by the IRS. Okay? So you're gonna have to know revenue rulings are published in the Internal Revenue Bulletins and later in the cumulative bulletins. I don't know why, but they seem to think that's important. And every test seems to have that stuff in there. They want you to know revenue rulings. Okay.
Internal revenue bulletins, where do those come out?
Where do they come out?
Yeah, how are they?
They're published, I don't know who by. And they're published periodically. And then, say if you're a tax lawyer, you'd probably take it and go read every one of them, or at least review it. In our case, they're gonna say later on, publications, the ones we use, are not. You can't use that to substantiate a case. You can't use publications. Publication 17, which I used to teach from for 15 to 20 years, has no force of law. We'll get there later. Revenue procedures, an official IRS statement that prescribes procedures. That's who follows that? The IRS. Revenue procedures do not have the force and effect of law. Okay, so that doesn't mean, you got to know this. I hate to tell you. What? Right. It's not the same as law. Tax law. You go read IRC, Internal Revenue Code, that's the law. Okay? Boring. The Internal Revenue Service Bulletin is an authoritative instrument of the Commissioner of the Internal Revenue Service for announcing IRS rules and procedures. Okay? So the IRS publishes this, And I can't remember how often.
On weekly, basis by the GPO.
Okay, announcement or public pronunciations on matter of general interest, such as effective dates of temporary regulations. Notices, okay, all of these things, you're just basically gonna read them and understand, just read them. Notices of public announcement issued by the IRS, okay. Delegation orders, commissioner, delegation orders formally delegate authority to perform certain tasks and make certain decisions to specified IRS employees. I've never seen one of those in real life. But they might give certain employees in certain areas rights that I'm not familiar with. Authority of ruling procedures. Rulings do not have the force and effect of the Treasury Department regulations. Okay, but they can be used as precedent. Publication, IRS publication. Oh, this is what I hate. IRS publications explain the law in plain language for taxpayers and idiots like your teacher. They typically highlight changes in the law, provide examples. Publications are non-binding on the IRS. Maybe that's why that lady didn't like me reading it. And do not necessarily cover all positions for a given issue. While a good source of general information, publications should not be cited to sustain a position. So you can't say to the IRS, this is my dependent because it says in publication 17, this is my son or daughter under age 17, live with me more than half the year, did not support themselves, and is not married, and is a U.S. citizen. So you can't use that to say, that's my dependent.
You would have to say like an IRC code sub.
Yes, you would.
6B. Yeah.
Okay, that's one of my little pet peeves. I hate that. But it's been there a long time. Private letter rulings represent the conclusion of the IRS for an individual taxpayer. So they apply to that one guy, but they don't apply to everything else. That's just is confined to a specific case. Okay. Technical advice memos. Just read that. Other private letter rulings and memos, general counsel memos, technical memos, the IRS manual. The IRS is bound by the procedural manual for the IRS, but the politics and guidelines contained in the manual are not legally binding. Okay, go to page 150, the court system. I hate to tell you this, you need to get this and get it down. They're gonna have a question. So you see the little diagram, tax court and district court and bankruptcy court go to the U.S. Circuit Court of Appeals. Know that they have a question in your deal about this. The U.S. Court of Appeals for Federal Circuit is for the U.S. Court of Federal Claims. I'm not even sure the difference between the two, but you got to know which way they go because they're going to give you that. Decisions of the tax court are issued as either regular reports or memorandum. Memorandum decisions are of little value as precedent. Need to know that. That's what it would be. Cases of the U.S. Tax Court and the U.S. District Courts are appealed to the appropriate Circuit Court of Appeals. I don't know why they would that, but they want you to know all this. So this is another one they want you to know. A writ of certitoria, I can't even pronounce it, is an order by the Supreme Court to send a case up to for its consideration. It's discretionary. The Supreme Court doesn't have to take a case. A denial of a petition means they expresses no opinion on the matter of the case. Who does this come from? If the court determines a very low courts are deciding issue inconsiderate, it may pronounce a decision and resolve. I believe the person has to petition a writ of certiorari, certiorari, of some word like this. Yeah, the taxpayer. It's not the court that sends it up. It's the taxpayer has to petition for it, the Supreme Court. An appellant in an appropriate case may petition. An appellant. Would that be either side? This is for sure. The next on page 151, the difference between acquiescence and non-acquiescence. Acquiescence means that the Commissioner of the IRS agrees with the court decision and will abide by it. Non-acquiescence means that they're not. So they still have to abide by that court's decision in that case for that jurisdiction, but they don't have to abide by it other places. Okay? Statutory contains case histories and recent case developments such as appeals, writs of whatever that word is, and related cases. They're published commercially. That means you can buy them. Only people I know that buy them are lawyers. Probably a few account CPAs, but not. Dictum is a court statement of opinion. This you gotta need to know it. You need to know both of these. It's a court statement of opinion on a legal point that is not necessary for the decision. So the court makes a decision about a case, but on the side it goes, oh, by the way, we find that this is also true. And I can't give you a good answer. What does that mean? They have a decision about if it's your child, the child lives with you, that's your dependent. And by the way, that also applies to your foster child or your adopted child. That wasn't in this case, but it would also apply like that. A court's statement of an opinion on a legal point that is not necessarily for the decision of that case. Okay? So it's not controlling to any other court, but it may be persuasive. Decisions of the court other than the Supreme Court are binding on the commissioner only for a particular taxpayer and the year liquidated. Litigated, not liquidated. Okay, so that is an important one. Remember, just because the decision of the lower courts doesn't mean the IRS has to follow it for all cases. But if after one or two lower courts go, well, this guy over here found this, we agree. And this court over here goes, we agree. After about two or three of them, then maybe the commissioner will finally go, okay, you win. I acquiesce. I'll do it for everybody. Okay, here's another important one. The IRS code is federal law. All courts are bound by the code. All courts. Does that include the Supreme Court? Yeah, it does. Unless it's something in there is unconstitutional. I don't think they say that in here, but one last page. Tax research. There's primary authority and supporting authority. Against my belief, up 17 is not primary authority. But I think they're wrong, but they're not paying attention. So what is primary authority? Okay, consists of the law enacted by the legislature plus its official interpretation and indications of its meetings. Primary authority, there's you a list. All that's primary. Everything else is secondary. Secondary authority should be used as supporting authority only to supplement supporting primary authority. So if you want to prove your point, you're going, oh no, IRS, you can't say just because he doesn't have a mileage log that you're going to disallow his miles. You better have something in here that says you can do that. I don't think you do, because the truth is, they can disallow if you haven't got any proof or receipts like you're talking about. The IRS can say, no, hell no, we're not giving you nothing. I personally believe the guy's making a mistake, that he should go, you could reconstruct his expenses as best you can. If he's going, I paid for everything with cash, I have no receipts, I don't remember anything, well, that's on him. I probably wouldn't have filed his tax return that way. I would file it the way you did it without any receipts, but I would document that I told him all this stuff, he chose to do that against my wishes.
It's a key word, against my wishes, against my advisement.
Yeah.
Yeah.
All right, so we have one last chapter next week, and you're going to take the test. You've already taken part 1. Are you going to take part 3?
I guess so. Yes, I will. I just have
Part
to schedule
3,
it.
more than any other part, is less on calculations and more on just reading. So, I suggest, more so than any, that you do every one of these problems and do the problems for part 3 that you have online, and just over until you get them, because this is just boring reading. I did it just because I can't sit up here and explain this to you without reading it myself. And a lot of it's just reading, especially these 2 chapters. They're the worst. Now, we get to the next chapter. It's one of my favorites. It's going to be electronic filing. I was in the beginning of electronic filing. In fact, I was on the first, the IRS had these meetings about it, and I was on the first panel with, there was a guy from H&R Block, and there were a couple other people, and I can't remember anybody's name. Dennis something was the H&R Block guy. There was criminal investigation. There was the head of electronic filing in the state of Hawaii. They don't even have one anymore. But that was in 1991 or 2. And so we were talking electronic filing, and really it got down, it was earned income credit. Was somehow in there. But that's when we were trying to convince everybody to electronically file. Not everybody was. Even the majority of the tax practitioners weren't. None of the CPAs. Until they found out they can get their money faster. Ooh, then they would go to somebody like Tax Busters or H&R Block and have their money within 24 hours. And then all of a sudden their clients started leaving and going to somebody else, and then they go, oh, wait a minute, maybe electronic filing is not so bad. Do you guys have any questions about these 2 chapters? I wish I could help you more, but they're small, there's not that much. But the things that those highlights that we went over, they're going to ask you questions about it. And they're going to be a little bit confusing. Now, let me see. I've probably at least for 15 years read this same stuff. I don't remember it from one year to the next. I never use hardly any of it. Now, that's not true. The part where offering compromise installment agreements,
That's what you can do.
yeah, regularly. But the rest of it, when they start talking about, primary, secondary. Okay, and if any of you guys, now that tax season's over, if you need any help with any of this stuff, fine, I'll go over any of this. Next week, we're gonna finish this chapter up and we're gonna review it. If you have any questions, email me and I will answer them for you. If you wait and surprise me next week on Tuesday, I may not have the answer as fast. Huh?
Someone
Yeah,
opened.
someone went out.
Yeah,
That's okay, I bet it's Susan.
Yeah, it was a girl.
I just saw the
I just
door
saw the head
moving.
go out.
Maybe not.
No, no go.
There was somebody.
No, there was
We all
someone.
saw
I
it.
saw
Oh, okay. I just saw the door like.
No, I saw someone walking earlier.
Oh. When are you
Why
planning on
ladies?
taking the test?
Well, my test is on Friday.
Oh.
I don't think I'm not as like, I'm not as prepared as I wanted to be by this point because I have to work like the past 2 weeks, like more than I allotted for. So I was like, I don't have study time.
Do you do taxes?
Yeah, I work for CPA, so I was thinking kind of
Oh. Well, now you have time to study.
2 days. I have 2 days to study.
We got this.
Yeah. Just need some calculations. My thing is like I can't remember the court thing.
Oh no, I'm taking part 1 on Friday.
Oh.
I was bigger, so I wanted more time to study when I scheduled it. I thought, oh no, that was it. She was on vacation. She's going on vacation tomorrow. I'm like, oh, that's perfect. She'll be in the office. Like, I'll have time to study.
the bank had your checks. That was only a year or so.
Yeah, and that was 1 year.
Was it 35,000 even?
I'm sorry, I didn't think I borrowed, it was way before, it was way before here. Okay, so that was May. Sorry, 2008. But I was gonna say, just throw it at 40, I guess, because I know I did, I
Five
ignored it,
more.
I know, well. Dawn's, she likes to do stuff. And,
Gotta get it to the top of my mind.
that could cost you, if they go shopping, your wife wants to renovate it.
They've already done it. My wife spent 35,000 renovating a master.
35,000.
It's got walk-in, everything, walk-in showers, made for me when I was a little kid. Yes, I was involved.
I have it in my computer right now, let me see it. Just too stressed right now. Because here's hands-on therapy and this was, that was the year before. That's why. Yes. So actually 40,000 is probably right. Sounds like I came off pretty good.
Okay. This I also got, I believe you made $6,000. Your tuition. It's here.
I know yours is more. Now it's 4.
You'd rather me find this and you get it
I
all
would.
straight
I
than
would.
not ignore it and then come back and thank you later.
Oh, definitely. I mean, it's better to read it than to not read it, but.
Yeah, it also means that you didn't make it though. That's a good thing.
Yeah.
cell phone, 383. How much do you pay for a cell phone? $35.
And they actually have like commercials saying, no, no more than, and I just don't listen to some of them. Really. I have some people text me, just to feel, maybe sit, when I'm going to see customers, to call and say, I don't need it, less than, so the supply limit.
You know, you're actually, look, you're making 90 grand. You don't have that many expenses. So you're keeping most of the money you make. You are. And then you don't have a mortgage. You're placed now. I do have storage, that's one of the other things. But storage is only how much? also, you made a bunch of, look, you got a state tax refund last year.
Yeah.
You had 77,000, almost 78,000 with regular income, and 44,000. Then you had, that's just,
Yeah.
oh, that's the royalties.
Yeah. So where is the, medical exam?
So,
Does it go somewhere else?
I don't know.
Oh, it doesn't? Oh, okay. So I figured you did the refund, I understand, one thing, that they use.
But on the state, you get to deduct the state tax you pay as a deduction. So self-employment tax, half of it, your, SAP, and your medical insurance, subtract all those. That knocks the same down a little bit. There's your self-employment tax, there's estimated taxes on the federal of 25 grand.
Yeah, I know, I just,
But you made, a bunch of money. And we haven't even talked about your interest and dividends.
so it's.
Another 16. Got a rolling capacity.
That's the one my mom, that, gets in there.
So,
Her,
minus all your itemized deductions, minus all the qualified business deduction, that's a good one. Brings your taxable income down to 85,000. That still means you're paying a bunch of taxes. That's not so bad. It's the self-employment taxes. So,